Welcome today. We're going to look at something that affects both accounting and finance today. A lot of people have raised questions and get confused in an area of accounting/finance called amortized loans. What this is it's a type of loan. So let's look at what this is and how it differs from what we have studied previously in most of your courses. The definition of an amortized loan is it's a scheduled periodic payment. It applies to both interest and principal. That makes a little bit different than what we've talked about in other types of interest. The first thing that it does is it pays off the interest expense for the period, and then what's remaining goes to the principal. And there's a relationship here. This is typically used in auto loans, home loans, personal loans from banks. Take a look at this and understand where this is. I'm going to give you some tools here that will help you moving forward in calculating this. How the amortized loan works is that the interest is calculated on the most recent ending of the balance. The interest portion of the loan payment decreases as the payments are made. So you have it at one level and it keeps going down each time you make a payment. Now when we talk about a period, keep in mind typically a period is 1 month. That does not necessarily mean it could be 1 month. It could be, depending upon how they're set up, it can also be bi-monthly. So, and again, just like the other way, instead of being monthly, it could be yearly, or it could be semi-yearly or quarterly. It depends on how it's done, but it's still going to be calculated the same way. Payments in excess of the interest reduce the principal, and so as you're making the interest payments, you're going to see that the principal reduces with each one. The interest portion decreases, the principal portion increases. So it makes sense on how it goes. They have a relationship. The interest and the principal have an inverse relationship. So they're relational to each other, but they're opposite. So if one goes up, the other goes down. If the other goes down, the other goes up. So you have to keep this in mind about how these work. We've talked about in previous courses and times about simple interest. And we've all seen this equation, I equals P times R times T, where I is interest, P is principal, R is rate, T is time. This is for using to gain wealth. In other words, increase assets. If you put money in a certificate of deposit, in a savings account, in anything of this nature, in a bank like that, this is how it's going to be calculated. This is not typically used when you owe money to others. That's where amortization comes in. All right, what we need to do to determine and figure out how an amortization table is going to work, the first thing we need to do is figure out the monthly payment. For these equations, monthly payment is represented by A. You're going to need required information to calculate this. The principal, which is represented by P, rate per year, which is represented by R, and the number of periods in the loan represented by N. If you see at the bottom of this slide here, there are two equations. Now this may sound contradictory. It does not matter which one you use. They both come out to the same answer. And I will demonstrate that for you so that you can keep that. So if you ever need to look at it, come back to this particular information. You will see this. In this video, you will see a file attached to it. This file is for a Excel slide. It will give you something that you can keep and use on a regular basis. So I want to look at that. If you look at the bottom of it, and what you're seeing here on this slide is the actual file. You'll see Formula 1 and Formula 2. And as you see on this slide, this is the one formula that it represents. So you can do this, and it all works the same way. So both formulas will help you calculate it together and it come up with the same answer. I want you to know that when you have this, there are hidden columns there. If you mess with this file in this worksheet, this workbook, you will make it inoperable. So don't ever kind of modify it unless I show you, and I will show you how to modify the table to get the length if you want to do it. But just keep in mind that there are hidden columns here. If you're curious, you can open those and you can actually figure out as you adjust it how this formula works. So it has a step-by-step process. So it can also be educational if you want to. If you're not really good with Excel, I would recommend not doing it. The required information we gotta have, here's the annual interest rate. You're going to put that in a percentage annually, no matter what it is. Then you're going to put the years in here. If you put the years, and the typical car loan is 6 years, so I've set this up for a car loan. 6 years, you will see that there are payments per year, 12. That's going to be standard because it's one per each month. And you'll see another total of months, 72 months. If you change the years, the total months will adjust automatically. So you only have to change this one. So let's say you want to use this for a mortgage. Change that 6 to a 30, and it will automatically calculate 360 periods, or 360 months. The next thing you're going to do is put in the total amount. Does not matter what it is. If you put this in, you will figure out what it is. When you do that, the very first thing that comes down is it will complete the table. In the second column, in column B, it will show you what your monthly payment is. And that will stay the same throughout the whole time of this loan. That never changes. If you look next to it, you will see what the principal amount is of that payment and how much interest. And it will show you the balance of the principal. So you can follow this down. This one is set up for 72 months for a car loan. If you would like to, and you want to adjust this to calculate for like a mortgage, and you're going to have 360, all you need to do is highlight that last row right there. And when it does that, it'll come up with the little handle, and you draw the handle all the way down until you have, in the first column, 360 periods there, or payments. So you can actually see this come all the way down. All these loans, as you can see, in this case, it's 72 months for a 6-year car loan. It tells you that last payment ends with a balance of 0. So as you come down, you can actually figure this out. Again, this file can be used for car loans, mortgages, or personal loans. Now that we have looked at this, what I want to do is I want to actually show you the file that we're going to use. Here is the file, and as you can see, this is Formula 2, and this is Formula 1. If you change anything in here, this will all change. So let's say that we're going to change this to $36,000, all right? And we want to change the interest to 2%. As you can see, it automatically calculated. It shows the monthly payment at $531.02. And if you see this and scroll all the way down, over the life of the period of the loan, 72 months, it ends with a 0. So again, download this, keep this, because this will become a handy little file to have in the future, all right? As you go through and you develop your skills in business, you're going to want to have tools like this. This is one way to do it, all right? I hope that this has been informative. I hope you understand the difference between simple interest and an amortized loan at this point. If you have any questions, you know how to contact me. I look forward to talking to you soon. Have a great day.